What if I told you one of America's biggest banks is trading at a surprisingly reasonable valuation? It's making over $21 billion in annual profit, yet it still pays investors a dividend. So the big question is Wells Fargo a smart dividend investment today? Let's dive into the numbers. Wells Fargo, trading under the ticker WFC, is one of the largest banks in the United States. With a massive $264 billion market capitalization, it serves millions of customers across consumer banking, mortgages, wealth management, and commercial lending. This isn't a small regional bank, it's a financial giant. At the time of this analysis, Wells Fargo is trading around $86.33 per share. The stock is down about 1.35% today. But one red day doesn't define a long-term investment. Let's see what the fundamentals say. The first thing I always check is profitability. Wells Fargo generated $21.34 billion in net income. Its annual revenue reached $84.4 billion. Those are impressive numbers. A company making this much money has the ability to reward shareholders through dividends and buybacks. Now let's talk valuation. The stock trades at a P/E ratio of just 12.8. That means investors are paying about $13 for every dollar of earnings. Compared with many large U.S. companies, that's a fairly reasonable valuation. It doesn't look overpriced. Now to the question many investors care about, the dividend. Wells Fargo currently offers a dividend yield of around 2.06%. Is that good? Yes. But it's not considered a high-yield dividend stock. If you're chasing maximum income, there are higher-yield alternatives. However, if you're looking for a dividend that can grow over time, Wells Fargo becomes much more interesting. Another positive sign is the stock's beta of 0.67. A beta below 1 means the stock generally moves less than the overall market. That can make Wells Fargo a relatively stable choice during volatile market conditions. No investment is perfect. Banks are heavily influenced by interest rates, loan defaults, economic slowdowns, and government regulations can all impact future profits. These are risks every bank investor should understand. Here's why many long-term investors remain optimistic. Strong earnings, reasonable valuation, healthy profitability, growing investment banking business, and management continues improving efficiency. These factors could support both future earnings growth and dividend increases. On the other hand, the dividend yield isn't particularly high. If your only goal is maximizing passive income today, this may not be your best choice. Investors expecting rapid price appreciation may also need patience. So how would I approach Wells Fargo? Instead of buying all at once, consider buying gradually over time. This strategy helps reduce the risk of entering at the wrong price. Long-term investors often benefit from dollar cost averaging. So, is Wells Fargo a buy for dividends? My answer is yes, for long-term dividend growth investors. Not because it offers the highest yield today, but because it combines solid profits, reasonable valuation, financial strength, and the potential for growing shareholder returns over time. If you're building a long-term portfolio, Wells Fargo deserves a place on your watch list. What do you think? Would you buy Wells Fargo at these levels? Or are you waiting for a bigger pullback? Let me know in the comments below. If you enjoyed this analysis, don't forget to like, subscribe, and turn on notifications for more U.S. stock market insights. Thanks for watching, and I'll see you in the next video.